Welcome to our channel Practical Study Planet. Please subscribe our channel if yet not subscribe it and press bell icon for further updates. Accounting Lecture 7. Today we will learn about the capital and revenue items in accounting. Why revenue and capital divisions in accounting? Difference between revenue and capital expenditure. Difference between revenue and capital receipts. Capital and revenue payments. Deferred revenue expenditure, capitalized expenditure, capitalized, capital and revenue profits, capital and revenue losses. First of all, we will learn about why revenue and capital divisions in accounting. There are always inflow money transactions and outflow money transactions in every business. Some transactions might be of short terms, less than one accounting period, effect known as revenue transactions, and some might be of long-term effect, more than one accounting period, known as capital transactions. So based on the period and nature, this division in accounting exists for a standard accounting practice for final accounts. Difference between revenue and capital expenditure. First of all, we learn that what is expenditure? The money spent for acquiring materialistic things in business, for getting benefit for the business from them. For example, money paid for purchase of stationery, purchase of goods, purchase of building, purchase of vehicle, etc. Whereas the expired value or cost of assets, materialistic things used in the process of generating earning for the business within an short-term accounting period is called expense. All expenses always will be out of expenditures, but all expenditure don't mean all expenses. Some expenditures might be for expenses, short terms are called revenue expenditures, and some expenditures might be for assets, long term or called capital expenditure. The major differences are in the tabular form below. Revenue expenditure, the first one, short-term effect, benefit less than one accounting year. For example, wages expenses, salary expenses, stationery expenses, fuel expenses, utility, rent, insurance expense, etc. Whereas the capital expenditure, long-term effect, benefit more than one accounting year. For example, the building, vehicle, machinery, furniture, etc. The second difference, due to such expenditures, no value addition in the asset but might decrease, if any. For example, repair and maintenance, depreciation, etc. Whereas the capital expenditure increase in the value of assets, rehauling of assets, renewal of asset, etc. The third difference is that one, it has no physical existence as it is incurred on items used by business. Whereas the capital expenditure has the physical existence except intangible assets. The fourth one, it is routine and regular recurring in business. Whereas the capital, it is irregular and non-recurring in business. The fifth one, this helps the business to keep in smooth operation. Whereas the capital, this solidify the business financial position. The sixth one, revenue expenditures are closed under income statement, whereas the sum part of assets in shape of depreciation shown under the income statement and rest in balance sheet. The seventh one, the revenue expenditure does not carry to the balance sheet, whereas the capital expenditure exists in the balance sheet until completely not existed. The eighth difference, revenue expenditure affects the business profit negatively, whereas the capital expenditure does not affect the business profit negatively because no concern with the income statement. Now the difference between revenue and capital receipts. The first one, revenue receipt, the short-term effect, benefit less than one accounting year. For example, the receipts against sales of goods, interest received, commission received, dividends received, etc. Whereas the capital receipt, long-term effect, benefit more than one accounting year. For example, the loan for the business, investment by the owner. The second difference, revenue receipt, due to such receipts no addition or deduction in the assets or liability. Whereas increase in the value of liability and decrease in the value of assets, for example loan from the bank or sales of fixed assets. The third difference, it does not produce capital, whereas the capital receipt produces the capital by investing the amount by the owner. Capital increases. The fourth difference, it is the routine and regular recurring business, whereas in capital receipt it is irregular and non-recurring business. The fifth one, all receipts are closed under income statement, that is the revenue receipt, whereas the capital receipt it is mentioned in the balance sheet at liability side. The sixth difference, it affects the business profit positively because it is a revenue receipts, whereas the capital receipt it does not affect the business profit positively because no concern with the income statement. Capital and revenue payments. Capital payments, the amount paid for the capital expenditure is called the capital payments. For example, paid for the furniture, building, machinery, etc. Capital payments, the amount paid for the revenue expenditure is called the revenue payments. For example, paid for the salary, commission, fuel and stationery, etc. Deferred revenue expenditure. The huge amount of revenue expenditure which is benefit is to be availed over the 6 months or more or over the years. It is called the deferred revenue expenditure. A portion of that expenditure treated as a revenue expenditure in income statement and the rest to be carried forward to the balance sheet under asset side to be written off gradually. In actual, it's not real assets called the fictitious assets having no market value, but the expense already have done. For example, establish new company and incurred preliminary expenses, huge amount spent in R&D, huge amount spent in product advertisement, heavy amount spent on the repairing of property or shifting of business location. Capitalized expenditure. Some expenses are of revenue expenditures but directly connected to the fixed asset during the acquisition of it. Such expenditures are added to the cost of the fixed assets and called capitalized expenditure. For example, installation of machinery will be added to the cost of the machinery assets. If current capacity of working increased by the repairing or adding any parts to the machinery, that also will be treated as capitalized expenditure and will be added in the fixed asset by debiting the assets account rather than the debiting any other revenue expense account. Let's give an example here. The machinery will be debited, machinery parts replaced and production capacity now double, and the cash or whatever the bank, the account through which the payment has been made, that will be the credit paid for the machinery repairing. Capital and revenue profit. Capital profit, the profit on sales of fixed assets is called the capital profit. For example, the profit on sale of the old furniture or more than value after the depreciation. Revenue profit, the profit on ordinary regular sales of goods is called the revenue profit. For example, the profit on sale of stock more than its cost value. Capital and revenue loss. Capital loss, the loss on sales of fixed assets is called capital loss. For example, loss on sales of old furniture less than value after depreciation. Revenue loss, the loss on ordinary regular sales of goods is called revenue loss. For example, loss on sales of stock less than its cost value sold. Thanks for watching the video. Please like, share and comment. Be connected with us for such informative videos.